Private equity secrets. What are the dark secrets of private equity? Hi, I'm John Taylor, founder, State and Park Capital, best-selling author of Maximize Your Multiple, The Business Owner's Guide to the Institutional Money Deal. So I talk to business owners all the time, and one topic that comes up often is private equity and selling to a private equity firm. And some have a rather dark view of private equity. Maybe in some cases that reputation is deserved. But certainly look, they're very well-run businesses owned by private equity firms that have done very well over the years. But no question. I mean, there are there's kind of a dark underbelly in some ways to the private equity industry. And so what I'll try to do is maybe talk through some of those. And I read an article in the Wall Street Journal that came out last month that talked about there's been a significant uptick in private equity-backed company bankruptcy filings in 2023, which was basically double what it was in the previous 2 years. And I think a lot of that's probably just driven by a higher interest rate environment, no doubt. I mean, certainly Silicon Valley Bank. I mean, there's been some other bank failures, and a lot of private equity-backed companies are the purchase of those businesses is funded by debt, which a lot of that, some of that debt is variable interest, and so as interest rates go up, the cost of that debt might become difficult for the business to service, right? Especially in a we're heading potentially into a recessionary environment. Some businesses are down, constraining corporate profits, so that's certainly an issue. But and I looked up what were some of the largest private equity-backed company failures of all time. So some of those were Energy Future Holdings Corp. In 2014. This was bought by a consortium of private equity firms, including KKR, Texas Pacific Group, Goldman Sachs Capital Partners. This was a leveraged buyout that happened in 2007, but it was a $40 billion in debt bankruptcy. Caesars Entertainment Corp. In 2015 filed bankruptcy with $18 billion in debt, which is backed by Texas Pacific Group, Apollo Group, which bought the business in 2000. I don't know that we're going to shed tears over a gambling business, but I mean, certainly Caesars continues to operate, so they did go through bankruptcy. Toys R Us, beloved to children of my era. I remember going to Toys R Us as a kid, but they filed bankruptcy. I think they were just one of these retailers that was affected by this major consolidation trend in retail overall, which has seen a lot of retail bankruptcies. But the Toys R Us bankruptcy happened in 2017 with $5.2 billion in debt, and that business was backed by Bain, KKR, and Vornado Realty Trust. iHeartMedia in 2018 was the fourth largest private equity-backed company business bankruptcy of all time. So that was formerly known as Clear Channel Communications, filed for bankruptcy with $20 billion in debt, backed by Bain and Thomas H. Lee, which was purchased in 2008. J. Crew in 2020 filed for bankruptcy with over $1.7 billion in debt, and they were taken private in a leveraged buyout by Texas Pacific Group and Leonard Green Partners. So as you see, like for some of these big buyouts, it's a lot of the same names, and that makes sense because there's only a handful of funds that have, really got to be, you got to have tens of billions of dollars to participate in some of these big deals. So it makes sense that you're going to hear some of the same names coming up, right? But yeah, it was interesting. So J. Crew was a store that, my wife and I used to shop at years ago, and then we noticed that once they were bought out by a private equity firm, you see the quality of the products began to, the clothing looked more like tissue paper. You wash it once and it's almost unwearable, right? So, I think there was a natural product store, some of these smoothie stores that were bought out by private equity. You see like a subsequent reduction in quality. I think this gets to the main point around, when you have private equity running a business. I think kind of the classic issue that comes up in business, I think it was identified years ago, but it's this quality versus cost, right? So, I mean, there's kind of two major, if you talk to the HBR folks, there's two major strategies in business. It's quality. You have a quality strategy, high quality product versus a low cost product, right? Which appeals more to the masses. But in any case, so the cost versus quality base. So if your business is run by finance guys, which in a lot of ways are just kind of bean counters, and I think maybe sometimes the cost wins out where there's a temptation to take costs out of the business, which inevitably has some effect on quality, which, whether it's perceived or real or otherwise. But I think that that's certainly quite common when a company gets purchased by private equity. You do see more of a shift towards cost reduction versus quality. Private equity firms, so the fees they charge are rather exorbitant. I mean, private equity touts very strong returns, and no doubt they have been for years and years, which is why a lot of institutional capital has flowed to private equity segment over the years. But the fees are rather large. It's 2% management fees, 20% of the profits. The management fees that get charged to the businesses. So the company charges private equity firms charge management fees not only to their limited partners who invest in their fund, but they also charge the businesses themselves management fees to basically provide oversight. And no doubt there's value to that, but again, I mean, for what they're paying for those fees, it's probably a lot more than what they're getting back. Which could probably be better spent on other things that could help build the business. Private equity deals are typically leveraged, so that increases the element of financial risk to the business. So bankruptcy, right, being more likely. A lot of business owners I work with tend to be very conservative people for the most part, don't like debt, but private equity likes to use debt because it increases the returns they can get on their investments, right? So if you're buying a company 50% debt, that's going to double your return. So it could turn a 10% return into a 20% return. And again, private equity firms, they're looking for very large returns. So 20, 30%, 40% kind of returns is what they're looking for typically. They're usually going to want control. I mean, that's another thing. So if you're selling your business to private equity, in most private equity firms are control only. So you're going to lose control of your business, and they're going to be calling the shots. So yeah, I mean, I think that those are kind of some of the major things to think about. When you're talking about private equity secrets. Feel free to send me some more if you have any additional thoughts on that. Again, check out my book, Maximize Your Multiple, The Business Owner's Guide to the Institutional Money Deal. Check out the links in the description below. Schedule a consultation with me. Thank you very much.